Hello and welcome to the Austin Morris Associates podcast. This is the first one of a series of podcasts that we'll be doing on a regular basis, talking about relevant issues in the current marketplace and new products, etc. My name is James Colbert, I'm the Managing Senior Partner of Austin Morris Associates, and today I'm joined by William Coppin, Partner at Austin Morris, and Mr. Mathew Riddington, Partner at Austin Morris Associates. So Matthew and William, there's been quite a lot of volatility in the markets over the last few weeks and some changes. What are your views on the current market situation and where you think they're going to be moving to?
I think we've seen a lot of the volatility sort of start to decrease over the last couple of days. 4 or 5 weeks ago, we saw a spike in the VIX index, which is a good measure of volatility and risk in the markets, mainly due to a couple of different factors. Ebola, obviously current issues, which is obviously dominating the markets, as well as the Hong Kong protests. A bit of uncertainty maybe with China and the ability to control and govern, a state which is Hong Kong. And then we've got Europe again from 2 years ago. IMF bailouts, money due to be paid back, potential bailouts needed for Greece again. Deflationary numbers and inflationary numbers are not looking good for Europe. So apart from the UK and Germany, most of Europe is deflationary, which is obviously very bad for business there. But on a positive, we've seen the euro slide a little bit and also pound weaken. So hopefully we're gonna start seeing some improvement in the UK and Europe, especially with the dollar having increased now. So I think that could start changing. But in summary, I'm still very bullish on equities. I think global equities, predominantly the developed markets, will have the best value at the moment. But certainly I think Matt's probably got some ideas as well himself. But at the moment, that's kind of where we're looking, buying in a developed markets, obviously buying low, and then waiting for a bounce.
Yeah, thanks very much, William. From my point of view, I think the important factor to me is this a correction or is this a medium to longer term trend? And I think the trend is not an issue in downward perspective. I think we've had a correction. We've seen markets falling for all of the reasons William's just sort of suggested. But the medium to longer term picture, I think, is still looking very, very buoyant. I think the developed equities that are now showing some strong value are looking outstanding. And in terms of opportunity, the Asian region has outperformed the volatility with some strong returns, particularly in the Asian region, Indonesia, Thailand, that's been positive throughout the last 3 months. So I'm still relatively bullish over this current issue. In addition, we've got to consider that throughout the last month we've had some good news. We've seen unemployment looking much better. The best unemployment figures since 2007 in the US and in UK looking very, very strong. We've seen quantitative easing, which again has come onto the table and again disappeared off the table. So it gives us, I believe, probably another 6 to 12 months of strong equity-based investment opportunity, where I still feel we're going to see some strong movement for the next 6 months to 12 months. So I'm very, very bullish on equities at this point. The current volatility is without doubt an opportunity, and certainly I believe we should be exploiting equities over and above the safer havens of bonds and gold at this point.
That's one good thing you bring up there, Matthew. The price of gold and obviously the current volatility. I guess simple economic theory would suggest that the gold price should be rallying at the moment and should have been over the last 3-4 months. But we've actually seen the inverse happen, and gold is actually correlated with equity markets. So we're seeing pretty much bonds, commodities, gold specifically, and equities moving in the same direction. When, say, pre-2008, we would have seen this flight to safety and this safe haven, gold, dollar, being used for that purpose. But Doesn't seem like there's an inflationary hedge there. Doesn't seem like there's a ability to move into a safe haven for protecting capital. So it is certainly equities that we need to be investing in for the very fact that if you're going to take the same risk investing in equities and say a safe haven, and they're both going to be moving in the same direction, equities certainly have the better upside longer term. So of course, no reason to invest in an asset class that's offering the same risk profile but less return. So I think equities are certainly, as you say, where we should be focusing.
Thank you very much. Appreciate that. Your views both seem very similar in as much as you're very, very bullish on equity markets and should be moving into those markets at this point in time. So we all agree that the current equity markets show great opportunities and we're all very bullish on where they're heading moving forward. However, you may have clients that are still not keen to move into the equity markets and are looking for alternative options. So based on that, Matthew, what would you be talking to your clients about at the moment?
Yeah, great question. And certainly, as mentioned, I'm very bullish on the equities, but still getting asked, what are the alternatives? What have we got in the marketplace? And one of the topics of conversation that keeps coming up time and time again is global properties. Specifically with regard to the London property market, Sydney and New York, which are three geographic locations that are of strongest interest. And as a company, certainly we've got access to funds that have direct links to property and to land, but direct property ownership is certainly something that it tends to excite a lot of the clients, and we're seeing market entry points from as low as 250,000 sterling in London, which is a great entry point, and still some very, very strong markets out there producing consistent double-digit growth. So an interesting option for clients who are not really into the equity markets.
Thanks for that, Matthew. William, any other options that you're talking to your clients about for alternative investments at the moment?
I think the sort of plan alternative investments very good. Makes sense to have something less correlated to the markets. You're not going to be affected by macro events. We can look at something more tangible, whether it's property or private equity, or whether it's some sort of alternative hedge funds or a hybrid. Doesn't really matter. Just depends on what we're looking at and the sort of time horizon for investment. I think in every portfolio, certainly it makes sense, whether it's 3 or 5%, to be invested in non-market traded assets. You get that diversification, and of course you get the opportunities if you're a little bit more inclined towards risk. Where maybe the traditional assets won't offer that. So no, like Matthew said, property's a great one. Could be private equity, could be any number of other kind of alternative assets, but I think there's a certain place in every portfolio, especially in the current markets. High volatility, your alternative assets won't be reacting as sort of as bad as maybe the equities and tradable assets.
Thank you very much, William. Appreciate your views, Matthew and William, on the current market situation and alternative investments that are available out there to any of your clients or potential clients. That's the end of the first Osmosis Associates podcast. Thank you.